Hey everyone, thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent jobs report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. It is the first week of the month, and during that first week, we get a ton of labor market data. We also get some labor market data throughout the month, but most of it comes in this first week. And so I like to just go through all the different charts. There's really no point in looking at it any more frequently than once a month. And you could even argue that once a month is probably too frequent in and of itself. But I did want to provide an update. There have been some new developments recently, so we will go through those in this video. So we're just going to go through the list because there's a lot of different things to look at here. We've actually added some new charts as well. So I want to go through some of those too. But essentially, we have unemployment statistics, employment statistics, job openings and turnovers. We also have population sentiment, labor indices, and income distribution, as well as many other things. But we're going to go through a lot of these charts. It's going to be somewhat dry, going to be pretty boring. It just is what it is, right? So the unemployment level has gone up 157,000 to 6.65 million. Now, this here has allowed the unemployment rate to finally hit 4%. And also, we're going to talk a little bit about the number of job openings per unemployed worker too once we get to job openings. But this has gone up. If you were to look at it this is for everyone greater than 16 years old. If you were to isolate it to say only 20 to 24-year-olds, you can see that it's really starting to spike. And I think this makes a lot of sense when you think about it, especially as we go through more of the data, but I'll give you a preview. One of the things we've noticed is that layoffs have actually been relatively low, and that is representative by the fact that initial claims are still really low, but continued claims are somewhat elevated still. And so the implication of that, and especially considering that the labor market is continuing to slowly loosen up, there's not a lot of people getting hired compared to a couple of years ago. There's not a lot of people quitting, but a lot of companies are still holding on to their workers. And so the people this would probably hit the hardest would be the younger people, right? The people that are just now trying to get a job. And those people are likely having a hard time just finding one, considering that, hires continues to drop. But that'll be something we look at a little bit later. You can go to unemployment level by reason for unemployment. You can look at job losers. It actually went down a little bit, but still generally trending higher, as you can see. Remember, the unemployment rate often moves in a nonlinear fashion, okay? It can slowly go up at first, but the longer that that rate cuts are delayed, we ultimately run the risk of it going up much quicker. Again, it hasn't made that move yet. This has been a fairly systematic and slow process, and it's fine as long as it does not accelerate. If you were to look at job losers on temporary layoff, also slightly down this week, we have permanent job losers. That has continued to move up, and that's up another 8,000 this week to 1.76 million. You can even look at new entrants to the labor force, and this is what I was talking about, right? New people to the labor force are having a much harder time getting a job. And if you think about it, with new people graduating college and whatnot, and hires continuing to go down, this is not the easiest job market to sort of get into, right? Again, if you already have a job, and your company's holding on to a lot of those people. Again, you've seen the headlines about layoffs. Be that as it may, I mean, layoffs are a normal part of any time of the business cycle. And so they have been relatively low, all things considered. And we'll see that with initial claims. But you're seeing people that say don't have jobs, they're having a hard time finding a new one or just finding one at all, right? And here's new entrants to labor force. That's actually gone up quite a bit here just over the last few months. You also have re-entrants to the labor force, so people who left it and now are trying to come back. That is starting to go back up a little bit as well. Now we go to the unemployment rate, and we did, of course, hit the 4% milestone. It's still not, I think it was actually 3.96%, so it just rounds up to 4%. Still relatively low given the historical record, right? But again, it's not about the absolute value. It's about the rate of change, right? It's about the rate of change, and that's ultimately what we're interested in right now. If you were to look at month over month change here, month over month change of the unemployment rate, it increased 0.1% 2 months in a row now. But again, quarter over quarter, year over year, it is not, it hasn't really made a huge move at this point. If you were to look at the unemployment rate per state, we're not going to go through all these, but again, there's ways that you can look at this chart that show you why there's so many different stories, right? There's so many different anecdotes. From some parts of the country, the labor market seems quite robust and strong, and like it's really hard to get a job. In fact, there's places in the Northeast that still have really low unemployment rate, and other places as well. If you look at something like Alabama, you can see that it's just been continuing to slowly go up. If you flip that over to obviously California, that one has been one of the ones that has been the weakest in terms of the labor market. That unemployment rate is up to 5.3%. But the counterpoint, of course, is that you could go to other areas of the country and see basically the complete opposite. If you were to go look at the Northeast, Massachusetts, the unemployment rate hasn't really been going up at all. It's down to 2.9%, and it hasn't really turned the corner. And then there's other places like that as well. So it really depends on what state you're in. Here's New York, for example. That one's actually, we saw it go up last year, but it's actually been decreasing, really ever since this year began. And so it goes to show just how region specific that the labor market is. Places in the Northeast are still doing relatively okay, but then you have out west and then places in the South that are starting to show some of that weakness. In fact, if you were to look at the number of states where the unemployment rate is going up over the last 6 months, we're currently at around 19. Now, what you'll notice is that in 2022, there was a wave of number of states where the unemployment rate had risen over the last 6 months, and it essentially started off at 0, and it went all the way up to about 31 or so before coming back down. But this move started in the summer, right? You can see that this move up, it started in the summer. And then we came back down, and then it put in a higher low at 5 states. Remember, the first low was 0. Then we had a high at 31, and then a higher low at 5. And then we had a higher high at 45. And then it's coming back down kind of the same time it came back down last year as well. Last year, we actually saw it bottom in the month of April, right? And we have the April data point here. And so the question is it going to do something very similar where it turns the corner this summer and goes back up, where essentially you get, 3 waves, right? You get your first wave of unemployment rising in some states back in 2022. That was sort of the getting out all the excess, the obvious excess in the labor market. 2023, still getting out some of that excess, but starting to inflict a little bit of pain. And we'll see where it goes in 2024 if it puts in another higher low and continues to go up. It's going to be obviously dependent on monetary policy, and while we have seen places like the ECB, the European Central Bank, and the Bank of Canada, they've already lowered interest rates by 25 basis points. We still haven't seen the Fed follow suit. And right now, the market is still thinking that the Fed is still several months away, with the most likely outcome at this time, I still believe, is not until September. So we'll see if that changes, but that's where it currently is. Now, do you remember where I said that the labor market is very region specific? This is a really interesting map. So this map shows, it colors the states orange that have a higher unemployment rate today than they did 6 months ago. And so this chart kind of shows how it's almost like a virus, right? Like it hits some parts of the country sort of unevenly, like out west, the unemployment rate has been going up, right? You can see Washington's at 4.8, Oregon's at 4.2, California's at 5.3. You go up to the Northeast and they're at 3.1, 2.6, 2.1. New York's up at 4.2, but Massachusetts is at 2.9. Pennsylvania's at 3.4. New Jersey's getting a little higher at 4.7, but and Delaware's at 3.9. You can see up here the labor market doesn't look so bad, but out west it doesn't look that great. And if you go in the South, it's sort of a mixed bag, but you can see that it is starting to go up in some of these southern states. In the sort of out in Colorado, if you're looking at like the Kansas and Missouri, the sort of the Midwest region, Indiana, Ohio, Kentucky, starting to see some signs there. But there's whole regions of the country where the unemployment rate has not gone up over the last 6 months. And I really do think that explains a lot of the discrepancies that you hear, right? You'll hear people out in tech, out in California, say that the job market's absolutely awful and that they can't find a job. But then you'll hear the exact opposite from maybe people up in the Northeast. And this kind of shows how, when you raise rates, industries are exhibit different levels of sensitivity to those interest rates. Some like high interest rates could hit some sectors, like the tech sector, a lot harder than it might hit other sectors. And that's why you sort of see it not match what you're hearing from different places. Okay. I think this chart does a really good job of illustrating why anecdotes change so much from one region of the country to another. We could also look at an alternative unemployment rate measure. There's obviously U1, which is just greater than 15 weeks. That actually ticked back up to 1.4%. You could look at U2. This is just job losers. Still slowly going up, but still not so bad. It hasn't really reached, sort of a parabolic move at this point. And then you could also look at things like U4, which is unemployed plus discouraged workers, and kind of see very similar patterns, right, across most of these things. People not in the labor force. These sorts of charts, I think it's probably best viewed on year-over-year percentage changes, and that's currently at around 0.7%. Now, we're going to go over to employment statistics. And first, we're going to start off with the labor force participation rate. It actually dropped slightly, which I imagine is not necessarily something that the Fed would like to see. I think they'd like to see more people, more people participating. But and we can look at it for different areas. We could look at it for, say, 16 to 19-year-olds and see that it's really been trending up for basically a decade now. Now we're going to go take a look at the civilian force or civilian labor force level. That actually dropped by about 250,000. Looking at a year-over-year percentage change, you can see it is dropping, and it's now down to about 0.545%. If we were to look at the unemployment level, this is kind of, is puzzling for a lot of people because you have two surveys, right? You have the establishment survey and the household survey. If you look at the establishment survey, it still looks relatively robust, right? If you look at a month-over-month percentage change, it's been moving up by about 0.1 to 0.2% month over month for quite a long period of time. And from this perspective, it looks pretty okay, right? And even a year-over-year percentage change has it all the way up at 1.77%. Still a relatively healthy level, all things considered. Now, when you change it to household, it tells a completely different story where it dropped 408,000. And if you look at a month-over-month percentage change of that, you can see that it has been increasingly negative recently. It actually went down even more late last year. Now, it's interesting because, you can see if you look at the year-over-year percentage change, the last one was obviously a lot healthier when you look at the establishment survey, but this survey is actually not even that far off of 0.2%. Just looking at it in terms of figures, year-over-year, only, what is this? Let me get this persons. Only 376,000 new jobs, right? According to the household survey. I mean, that's getting pretty close to negative. But again, it goes against what the establishment survey is saying. So one thing that I think is somewhat helpful is to say, all right, well, what if we try to remove our bias, okay, and say, all right, I don't know if I should believe the establishment survey. I don't know if I should believe the household survey. What if we say, why don't we just combine them, okay, and say, you know what, we'll weight them equally and just do that, okay? And I think that might be sort of the best way to go about it. So we're going to go over here, and we have both surveys. We're going to We're going to add them up and we're going to divide by 2. Okay, so we have the employment level survey, household survey, and the establishment survey. This is M1 and M2. We're going to add M1 and M2, divide by 2, evaluate that, and then you get this chart. And then we're going to isolate just that, and then also show, where it had previously turned negative before. These are these gray shaded regions, these recessions. And then if you zoom in, you can see that it is slowing down, right? It is slowing down. And actually, this last month was a decrease. But again, the process for it to actually completely play out is a very, very long process, right? The business cycle takes place over years, okay? And so, but I do think, if you weight them equally, the establishment survey and the household survey, and you say, you know what, I don't know which one's more accurate, we're just going to take the average. This is what it looks like. It's been increasing for the most part, starting to potentially plateau here. And this is probably one of the reasons why you see some banks, some central banks, like out of Europe, the ECB and the Bank of Canada, they're probably looking at pretty similar data in their own areas and thinking they need to cut. Even though inflation really hasn't durably come back down to their target, they're probably just looking at the labor market and seeing some weakness, and so they're trying to cut because they recognize there are long and variable lags with monetary policy. And so this is something that is definitely worthwhile to continue to follow, and we will continue to talk about this in the coming months. So let's get back to what we were talking about previously. So we just went through this chart, the employment level chart. Now we're going to go over to non-farm private payroll employment level. And this is one that still has been relatively robust. If you look at the year-over-year percentage change, it's currently at 1.8%. Now you can break this down into different categories, different sectors, and look at construction, and see that it's still adding employment pretty well so far. You could look at financial activities and see very similar things. Manufacturing, I think, looks a bit different. This is one that hasn't been doing nearly as well. And in fact, if you were to take a year-over-year change of this, it's actually been negative since June of 2023. We'll take a look at total temporary help services employees. This is one that's really been dropping ever since March of 2022, which is basically when the Fed started raising rates, right? So the Fed started raising rates, that March, I believe, of 2022. And ever since then, total temporary help services employees has been dropping from a high of 3.18 million down to 2.73 million today. A year-over-year percentage change shows that it's actually been negative since really the end of 2022. So you're seeing a lot of normalization in the labor market. Multiple job holders. This is always an interesting one to look at. It continues to slowly go up, but again, it's a stochastic process. It's not, if you look at the context of history, it doesn't just go straight up or straight down, but it does tend to generally increase with occasionally you get a recession, and then you'll see it go down. This is a new chart that we've added, and I'm not going to spend a ton of time on it, but it just shows job postings on Indeed in the United States, and essentially, it sort of normalizes it based on where it was back in sort of pre-pandemic. And you can see it for total. Right now it's at 112. Again, sort of the baseline would be pre-pandemic. It would be 100, right? So 100 corresponds to pre-pandemic. Right now it's about 12% or so above the pre-pandemic level for job postings on Indeed. But that's actually total listings. Some of the different categories look a lot different, right? So if you were to go to accounting, for instance, you can see that it's actually at around 14% above the pre-pandemic level. If you were to look at industrial engineering, you can see that it's below the pre-pandemic level at 92 to 93. If you were to look at mathematics, which I like looking at, that was my major in undergrad, it's actually at 78. So, you can certainly see that different areas have been hit harder. Some sectors seem fine, while other sectors seem like they've gone below the pre-pandemic levels, and they don't really show any signs of recovery at this point. Perhaps we could go look at management. This is one that has really started to fall off a cliff recently. It had sort of leveled out here really ever since March of 2023 until March of 2024, but ever since then it started to really drop here, and now it's nearly at the pre-pandemic level. Marketing is always an interesting one to check in on. That's also below pre-pandemic levels. So, I mean, you can see that a lot of the excess that the Fed has been concerned about, it is getting removed, right? It is getting removed. And where the risk is do they wait, do they pivot soon enough to sort of slowly reverse some of these trends before they have to go into outright panic mode, right? And that sort of is the question, and has been the question for a long time. And I think a lot of people sort of prematurely think that if it hasn't happened by a certain point, then it won't. But I would say, look, until they actually start to cut, and even when they cut, right, there's still a risk. There still is a risk that we have to contend with, and we'll have to see if they when they cut, how much they cut by. I imagine 25 basis points isn't going to be enough whenever they do decide to start to cut, but who knows? Maybe it will be sort of slowly 25 basis points, like what the ECB and the Bank of Canada is doing. Now, job openings. This is sort of like the thing on Indeed, but it's just sort of looking at the data that we're given via the government. Job openings total non-farm back at 8.06 million, still above the pre-pandemic highs of around 7 to 8 billion, but it is dropping. Total private has been dropping quite a bit. One of those charts we just looked at on Indeed, we saw it start to really drop this year, starting in like March, and you can see that this is also reflected in total job openings in the private sector. It's really starting to drop down here. Manufacturing. This is one that kind of looks like the inflation chart. If you think about it, like inflation kind of came down in the summer of 2023, and then it's just been going sideways for about a year. And then now you can see that total manufacturing job openings have finally gone lower than where they were over the last year or so. You can see they finally have gone lower, down to 516,000. Retail trade is one that has been struggling the most. The last time, excluding the pandemic, that retail trade job openings were at these levels, we're all the way back in like 2014. So I think the hard part is that tighter monetary policy affects some industries a lot more than it affects others. And it's unfortunate that if you find yourself in one of the industries that's more affected by it and you're just sort of waiting for lower rates, it's unfortunate because you just have to keep on waiting and waiting and waiting, because there's other sectors that the interest rates, the hikes haven't had as big of an effect on. And then we can look at leisure and hospitality job openings. Again, a lot of these are just slowly going down. Job quits level actually went back up, which I imagine is not something the Fed would want to see, because I imagine they want to see the labor market loosen up to reduce wage inflation. But quits actually went back up this last month. This is the same thing. Looking at the job quits rate, it's been about 2.2% for several months now. Now, initial claims. This is what you look at to sort of say, hey, look, I know there's been a lot of headlines for layoffs, but initial claims are still relatively low. Keep in mind, they have started to go up recently, but they also went up last year around this time, and they ultimately ended up topping out about mid-June or so. So yes, it is possible that initial claims go up. If it's going to be different than last year, you would need to see it continue to stay higher rather than sort of just fall back down at the end of the summer. So far, everything we've seen with initial claims is relatively seasonal. Of course, that could change. We also have things like initial claims per state. Obviously, this is not seasonally adjusted, but one thing that I like to do is kind of do the same thing that we did with with the unemployment rate 6 months previously, and just look at a map. And we're gonna come up with better ways to visualize this map, but it shows you initial claims, and you can sort of look, where they're the lowest, where they're the highest. Obviously, they're the highest in California. But I think we need to make some changes to this, because it's going to be higher, especially in states that have higher, larger populations. I think we do need to actually normalize this in some way. But this is what it looks like right now. You can look at the number of states where the percentage year over year initial claims is rising. We saw it spike up in mid 2023, and then it came back down. I usually think adding like a long-term moving average, like a 7-week SMA, is probably more helpful to look at these things. So you can see it's sort of off the lows, came back down, and we'll see what it does from here. Continued claims. This is one that had moved up a while back, but then it's just been flat at around 1.8 million or so. Continued claims per state, continued claims map. This one shows you how some of these states definitely have more continued claims than others, right? You're actually seeing more continued claims up in New York and Pennsylvania. Again, it's not the best way to visualize this because it's not normalized to the state's population, but hopefully in future videos we'll have something like that. And then finally, for this area, we can look at the number of states where the percentage year-over-year change is above a certain threshold. So if you say above 30%, it's actually relatively low right now at only 5 states. If you change this to say only 10%, then it's actually currently at around 23 states where the year-over-year percentage change of continued claims is more than 10%. Now, earlier I said that hires have actually been dropping quite a bit, and this chart shows that, and that's why you saw that category of younger people, say 20 to 24-year-olds, are having a harder time finding a job, and it's because the companies that already have a lot of the workers, they're sort of hoarding them and holding on to them and not laying them off as much, but they're not necessarily hiring a lot of new people, and that is reflective in the fact that hires are actually back below the pre-pandemic levels, right? So there's less hires today, 5.64 million today, than there was pre-pandemic of 6 million, and that's why again younger people are having a harder. They're sort of contributing to the unemployment rate more recently because they're just having a hard time finding a job because fewer and fewer companies are actually hiring. Okay. Still, we haven't really seen the turn in the business cycle where the unemployment rate really starts to accelerate. It has hit 4%. It is getting relatively high based on where it was, a while back of 3.4. Based on the historical record, it's still at a low level. And until you start to see layoffs in mass, it won't increase parabolically. Once you start to see layoffs happen sort of in mass, that's where you might actually see the unemployment rate start to go up a lot quicker. We could also look at some of the labor indices. We have the Kansas City Fed Labor Market Conditions Index. That's actually down now to 0.537, so it continues to slowly drop down off of these, off of some pretty high levels, right? And I mean, you can see what happened the last two business cycles, as it sort of slowly went down over here, and then at some point it just sort of fell off the cliff. But we haven't reached that point. It's hard to know how far away we are, right? It's really hard to know, and that's sort of a guessing game for the Fed as to whether they can achieve a soft landing or not. And then we also have the Kansas City Fed Labor Market Conditions Index. That's actually turned back up a little bit recently. There's also some other things that we can look at, and those are things like the SOM rule, the SOM rule recession indicator. It actually stayed flat this month, and you might say, well, why is that? Why did it stay flat? And it makes sense because remember, it's based on the 3-month moving average of the unemployment rate low, only going back 12 months. And now, if you go back 12 months, we're actually beyond the point where the 3-month SMA was at 3.5%. Now it's to like 3.53%. So despite the fact that the unemployment rate went up, the SOM rule, this didn't actually change. And so for it to actually trigger next month, the unemployment rate would have to come in at around, I calculated this earlier, I think 4.31%. So if it came in at 4.31% next month, then the SOM rule, I believe, would actually trigger. But if it only comes in at, say, 4.1 or 4.2, then it still won't, just because, your reference point is 12 months ago. And 12 months ago, that was when the labor market started to slowly turn up. So just sort of a caveat if you're not familiar with that. You can also look at the SOM rule recession indicator at the state level. It wasn't designed at the state level, but you can see that some states have already triggered the SOM rule, where essentially, the unemployment rate is 0.5% off of the low 3-month estimate low over the last 12 months. Some states like Alabama have already triggered that. Also, California triggered it obviously a while back, whereas other states, as we mentioned earlier, like Massachusetts, are nowhere near triggering it. And so what you can do is you can look at the number of states where the SOM rule has triggered and see that it's actually moved up off the lows of 0, and now it's just kind of right around 21 or so. So about 21 states in the country have triggered the SOM rule. Again, it wasn't made for that. And then here is a map of the states where the SOM rule has actually been triggered. And again, it shows you how it's sort of like a virus, right? It starts in some areas and it slowly spreads out. And ideally, what I'd like to do in the future as well is have a timeline of this so you can sort of scroll through it and see what it looked like, 6 months ago, what it looks like today, what it looks like, as time goes on. But again, this explains why some areas of the country still have a really great labor market, and then other parts of the country are struggling a bit more. I believe that's mostly it that I wanted to talk about in this video. Again, it's already been kind of a long video. I'm not even really sure what the reaction of Bitcoin has been since then. So Bitcoin has taken a bit of a hit here. It's back down around $69,000. And we've talked about this outcome before quite a bit. And we'll see what Bitcoin does here at sort of these range highs. Hasn't been able to break out just yet. And so, it's possible that it evolves into a 2019 scenario. But again, I don't have a crystal ball. We'll just have to see if it gets rejected here at the range highs, or if it musters up the strength to go through. I do think that with the unemployment rate at 4%, it is going to start to get the attention of some politicians, right? Again, it's still a historically low level, but I think a lot of people sort of think that politicians want it to be a certain way. But if you think about it, I don't even know if it's as obvious anymore, right? What would you prefer if you're a politician and you're trying to make it seem like things are going well? Would you prefer the unemployment rate to stay below 4%, therefore not really giving the Fed a great reason to lower rates? Or would you want the unemployment rate to go north of 4% so that you have a reason for the Fed to cut prior to the elections? And so I think it's not as obvious. I think that you could obviously make a case either way, but I think there is a compelling view that, there has to be some element of politicians that would like for the Fed to lower rates before the elections. And one way you do that is that you start to see some of this softer and softer data. And we've actually seen a lot of softer data over the last 2 months. And some of it is just surveys and that kind of stuff, fluffy stuff, not like hard data, but some of them have started to show some warning signs very, very slowly. Like the Chicago PMI, I believe that came in really, really low. But then you have other things like non-farm payroll today that completely blew out expectations out of the water. Again, the establishment survey looks really great. The household survey looks really bad. Who do you believe? I don't know. You probably just average them together to try to get the best unbiased view of what's actually happening. And if we actually pull up the unemployment rate, this is what it looks like right now, right? And I'm not really sure why this one is looking like that, but this is what it looks like. And it is slowly, it really is slowly starting to move up here. Yeah, it's a slow process, right? But, and these circles, I believe, were put here because we had a moving average sort of talk about them. So let me see if I can pull up a simple moving average. And all I'm going to do is add on a, what do I want to add on? Well, no, that'll be a monthly. I want to do weekly. So let's see if we can go over to let me just do a shorter term moving average. Let's go to a 20 month, right? So here's a 20 month SMA. And we're going to change this color so it's a little bit brighter for everyone to see it. So yeah, you can see that a lot of times when the unemployment rate goes north of the 20 month moving average, it doesn't really slow down for a while. And you can kind of see that's what's happening, right? It is happening. I think sometimes, we look at these charts and it just seems like it all plays out instantaneously. But when you actually look at this chart, you have to remember this chart's going back to 1948, right? Even this period right over here, that took 2 years, right? So, from where this, really started to get into this trough over here, it's been about 2 years or so. So it takes a long time to play out. And obviously a lot of things can happen in the markets during that time. But that is where we currently stand. with the market or the labor market, and we'll of course put out more videos on crypto and the effects on that. Obviously, you guys know my views. I generally think that the Bitcoin dominance will go a lot higher, and that altcoins will bleed back to Bitcoin until we actually get back to looser monetary policy. Some people would rightfully point out that, are we not getting there? Because we did see the Bank of Canada and we did see the ECB cut rates. We still haven't seen the Fed cut rates. And also, remember, last cycle, Bitcoin dominance did not even top until 2 months after the Fed cut. So it wasn't like dominance topped the minute the Fed cut rates. It topped 2 months after the Fed cut rates. And so we're still not there yet. Now, I think there's a compelling case to be made that the Fed might cut sooner than what the market is currently expecting. But we'll just take it. We'll take it one day at a time. That'll wrap it up for this video. Again, if you guys like the content, make sure you subscribe, give the video a thumbs up. And again, check out Into the Cryptoverse Premium at intothecryptoverse.com. You can, of course, get access to a lot of those macro charts that I was showing earlier on the website. We have a ton of different things you can follow along as well at your leisure. And we will wrap it up there. Thank you guys for tuning in. I'll see you guys next time. Bye.